Good evening. My name is Rob Misey, and welcome to another episode of my continuing series of international tax issues. Well, I don't know if your practice was like mine, but by the end of the year, I was just overwhelmed with all the M&A activities. Lots of mergers and acquisition activities at year end this year. And of course, it usually is like that. But there was an issue that I spotted that many times that I think a lot of people missed, and I want to make you aware of it. So today we're talking about that one-year wonder, the transition tax, or as I like to refer to it as the deemed repatriation regime, and how that impacts M&A issues with respect to S corporations. So let's have a brief review of the transition tax. Remember, it went into effect at the end of 2017. So here we have U.S. individual owning an S corp that wholly owns a CFC. That CFC had $3 million of E&P, and as its assets, $1 million constituted cash. Well, the deemed repatriation regime said that to the extent of E&P that they had cash, that's taxed at 15.5%. So 15.5% of $1 million is $155,000. The remaining $2 million of E&P, that was taxed at 8% for $160,000. The total tax, $315,000 under the transition tax. But there was good news for S corporations because S corporations could elect to indefinitely defer the transition tax. However, even if they deferred it, there might be acceleration events that would end deferral and result in having to report that $315,000. So, for example, suppose the S corporation was purchased by a foreign acquirer. That would terminate the S status. That would accelerate the transition tax. Say you did a Type C, share for asset reorganization, where the S corp gave up substantially all of its assets. Once again, that's an acceleration event triggering that $315,000. And finally, the very exhaustive all-inclusive, any transfer of S corporation shares. So if you're a foreign acquirer and you purchase the S corporation shares, that would trigger the transition tax. But here's the really bad news and the issue I want you to watch out for. That the S corporation, not just the S corporation shareholders, but the S corporation is jointly and severally liable for that $350,000 of transition tax. For those of you playing along at home with your code and regs, and who doesn't? It's always fun. That's Reg 1.965-7C4. So if you are representing the purchaser of an S corporation, you want to make sure that there are the appropriate warranties in the purchase agreement such that your client isn't getting stuck with a corporation that has this old transition tax liability of $315,000. Well, I hope you have a great rest of the day. Happy New Year, everyone.